A bank stress test is a financial assessment conducted by regulatory authorities or the bank's internal risk management teams to evaluate how well a financial institution would withstand adverse economic conditions or severe financial shocks. This simulation involves subjecting the bank's balance sheet, income statement, and capital adequacy to various hypothetical scenarios that test its resilience. The primary goal of a stress test is to ensure that banks have enough capital and liquidity to continue operating safely even in adverse economic conditions. Stress tests typically involve multiple scenarios, ranging from mild economic downturns to severe financial crises. These scenarios can encompass factors such as economic recessions, housing market collapses, stock market crashes, and other external shocks. By subjecting the bank to these scenarios, regulators and bank management can assess how vulnerable the institution is to different types and levels of financial stress. The stress testing process begins with data collection and scenario development. Historical financial data, macroeconomic indicators, and other relevant information are used to construct realistic yet severe scenarios. These scenarios are designed to reflect real-world challenges that could impact a bank's operations and financial health. Once the scenarios are established, banks input their financial data into sophisticated models that project the impact of the stress scenarios. These models consider variables such as loan defaults, market value changes, and changes in interest rates to estimate potential losses and changes in capital levels. By comparing the projected results under stress to regulatory capital requirements, banks can determine if they would meet these requirements in adverse conditions. The results of stress tests provide valuable insights into a bank's risk exposure and capital adequacy. If a bank's projected capital levels fall below regulatory requirements in a stress scenario, it may be required to take corrective actions, such as raising additional capital, adjusting its risk management practices, or reducing its exposure to risky assets. Stress tests have become a critical component of financial regulation and supervision in the aftermath of the 2008 global financial crisis. Regulatory authorities, such as the Federal Reserve in the United States and the European Banking Authority in Europe, conduct regular stress tests on major financial institutions to ensure financial stability and protect depositors and the broader economy. For investors and the public, the results of stress tests can provide valuable information about a bank's financial health and its ability to weather economic downturns. Positive stress test results can boost investor confidence, while negative results can lead to concerns about a bank's stability. In conclusion, a bank stress test is a comprehensive evaluation of a financial institution's ability to withstand adverse economic conditions. By subjecting banks to hypothetical stress scenarios and assessing their capital adequacy, regulators and bank management can identify vulnerabilities and take necessary actions to ensure financial stability and protect the broader economy. Stress tests play a crucial role in maintaining confidence in the banking sector and preventing financial crises.